Well, yield curves, the test question, Jennifer, I'm not sure what exam you said you're taking. If you're taking a SIE or a Series 65, you're not going to get tested on a positive yield curve. You're going to get tested on a negative yield curve. And a negative yield curve is when short-term rates are higher than long-term rates. And it's a negative leading economic indicator because that's what the Fed controls, right? We're worried that they're going to raise short-term rates so high that, instead of bringing us in for the mythical soft landing, they might do us with with a recession. And then that's testable. The negative yield curve, where short-term rates are higher than long-term rates, is a leading economic indicator, and it's an indicator of a recession, and that too is testable. A recession is 2 calendar quarters of declining GDP. Now, widen or narrow isn't about the yield curve. That's about the credit spread, the difference between what high quality debt and low credit quality debt pays. Today, the Wall Street Journal had a great article on how the yield curve between Treasury securities and junk bonds, how that is widening, right? The difference, what the risk premium people are demanding. And widening of the credit spread would be a negative economic indicator, because what it means is people are selling off their junk bonds, causing the price to go down and yields to go up, buying treasuries, causing the treasury securities to go up in price and yield to go down. So that widening would be bad and narrowing would be good. In terms of that, Lord John Maynard Keynes said money is like a giant floating crap game. It's always going from one place to another. So, the yield curve right now is pretty flat, which means there's a lot of uncertainty. What I just said there is there's not much difference between, short-term treasury notes, short-term treasury bills, and treasury bonds. Pretty flat. And that's, again, uncertainty. And then again, this idea of widen and narrow. So if you tell me you missed your mark, Jennifer, because of economics on SIE and 65, I'm going to say you had other problems. However, if anybody ever asks you about economics, finance, or investments, and you want to sound smart, you should say it has a lot to do with interest rates. And if you just shut up, you sound good. People say, well, what about them? You say they fluctuate. They say, is that good news or bad news? You say it depends. Now, here you go, Jennifer. Boy, you're not going to embarrass your firm at a cocktail party. You say, I've been watching the yield curve, and I'm a little concerned because it's flat right now. And I've been watching the credit spread, and it's been widening. Right? So it's really, don't embarrass the firm at a cocktail party level economics, not really being an economist, right?